Does managing your business finances feel like you're trying to decode a secret language? All that talk of debits and credits can make your head spin, and if you get it wrong, your financial reports suddenly make no sense. This confusion can lead to some seriously bad business decisions. But what if I told you that the bulk of your daily transactions boil down to just two simple journal entries? Today, I'm going to break down the two most important entries, purchases and sales, into easy, follow-along steps. We'll even follow a brand new business from its very first transaction. By the end of this, you'll be recording these with total confidence, feeling like you're finally in the driver's seat of your company's books. Section 1. The Golden Rule of Accounting. Alright, before we jump into any transactions, we need to lock down the one rule that governs everything in accounting: the accounting equation. It's surprisingly simple, yet incredibly powerful. Assets equals liabilities plus equity. Think of it this way. Assets are everything your business owns that has value. We're talking cash, inventory, that fancy new espresso machine, or even money owed to you by customers. Liabilities are everything your business owes to others. This could be a loan from the bank, a bill from your supplier, or an outstanding credit card balance. Equity is what's left for the owners after everything is settled. It's your personal stake in the company. Every single transaction, no matter how big or small, has to keep this equation in perfect balance. Once you get that fundamental principle, I promise the rest is just about slotting things into the right place. Section 2. The case study and the first purchase. Let's make this real. Say hello to Creative Canvas Co., our new t-shirt business. First things first, they need awesome shirts to sell. Creative Canvas buys 50 blank tees from a supplier for $500. The supplier is a good sport and gives them 30 days to pay. This is a classic purchase on credit, meaning no cash is changing hands today, but a debt has been created. So, how do we get this on the books? We need an entry that keeps our golden rule in balance. First, our inventory. The t-shirts just went up by $500. Inventory is an asset because it's something the company now owns and can sell for a profit. To make an asset account go up, you debit it. So we debit inventory for $500. Second, since we haven't paid yet, we now owe our supplier $500. That debt is a liability called accounts payable. To make a liability account go up, you credit it. So we credit accounts payable for $500. And there's our balanced entry. Debit inventory $500, credit accounts payable $500. Our assets went up by $500, and our liabilities also went up by $500. The equation stays perfectly balanced. See? Not so scary. Section 3. The first sale, the two-part magic trick. Now for the fun part, making some money. A customer comes in and buys one of our cool t-shirts for $30. They pay with cash right on the spot. This is the spot where most people get tripped up because a single sale actually requires a two-part journal entry to paint the full, accurate picture of what just happened. Part 1. Recording the cash you made. First, we receive $30 cash in the register. Cash is an asset. And what do we do to increase an asset? We debit it. So we debit cash for $30. That $30 also represents sales revenue, which is great for the business and boosts the company's equity. And to make a revenue account go up, you credit it. So we credit sales revenue for $30. The first part of our entry is debit cash $30, credit sales revenue $30. The accounting equation stays happy and balanced. Part 2, recording what it cost you. But wait, we're not done. This is the crucial step. To make that $30, we had to give something up. One of our t-shirts. We have to show that our inventory went down. Remember we bought 50 shirts for $500? That means our cost for each shirt is $10. This is what accountants call the cost of goods sold, or COGS. COGS is an expense, and expenses decrease your equity. To make an expense go up, you debit it. So we debit cost of goods sold for $10. At the same time, our inventory and asset decreased because a shirt literally walked out the door with a customer. To decrease an asset, you credit it. So we credit inventory for $10. The second entry is debit cost of goods sold $10, credit inventory $10. Once again, everything is perfectly in balance. By doing both parts, you get the true story. You don't just see the $30 you made, you also see the $10 it cost you, giving you a crystal clear look at your actual profit on that sale. And that's it. Seriously. Those two examples, the purchase and the two-part sale, are the bedrock of your day-to-day bookkeeping.